Yeah, good morning students. My voice, is it audible? Voice, is it audible? Yeah. Yeah. Today we will start with new chapter, income from house property, and the balance portion of salaries head we will discuss at the end of the session. So for any head there will be charging section. So what is the role of charging section is, it says whether a particular income is chargeable under this head or not. So for every head there will be charging section. Similarly for house property head, the charging section is section 22. Section 22. So section 22 of Income Tax Act says, section 22 of Income Tax Act says, annual value of property, that is building or any land appurtenant thereto, of which SSC is the owner, of which SSC is the owner, is chargeable to income tax under the head income from house property. Voice is clear? Any issues there? Can somebody respond? Voice, is it clear? Yeah. So now we are discussing charging section. For any head there will be charging section. Section 22 is meant for the house property charging section. So why house property, income from house property is taxable to income tax? The reason is SSC is receiving the rental income. So because SSC is receiving the rental income, income tax comes into picture. Because income is there, income tax comes into picture. Now how it is subjected to tax? What section 22 says is annual value of property. The word used is annual value of property. See, annual value of property is different from the actual receipt of rental income. Actually rent would have received some 1000 rupees, assume, but annual value is there some 2000. Then SSC has to pay tax on 2000. So there is a difference. So you should understand, under section 22, annual value of the property is taxable. So actual receipt of rent may be lesser than the annual value of property. Even in such case, SSC has to pay tax based on based on annual value of house property only. So what I want to say is, even though actual rental income is lesser, say actual rental income is just 1000 rupees, whereas annual value of house property is, HP means house property is 2000. So SSC has to pay tax on 2000 rupees only. Now what is annual value? What is annual value of house property? See, the name indicates it is annual. It is annual means yearly. So yearly value of house property. First it is clear. So value of the house property for that year. And it is the earning capacity of the house. See, department feels that if it goes by actual rental income, SSC may manipulate the income. See, and also there is a chance that SSC may give rent for lower side. Suppose tenant is SSC's relative, he may offer at lower rent. So that is the reason department wants to tax based on actual earning capacity of the house property than actual rental income. So suppose tenant is a relative, so in that area, suppose house property where it is located in that area, fair rent is assumed. Fair rent means normally for that house in that area, suppose 10,000 is there, but SSC given house on rent to his relative at 5,000. So if department taxes at 5,000, which is the actual receipt of rental income, then department may get lower income tax. So that is the reason that house can earn 10,000 rupees. Actual capacity of the house is 10,000, it can fetch the rent. So that is the reason department is not minding the actual rental income. It is going based on the earning capacity of the house. So this is clear. So this is the exceptional feature of this head. No other head is having this kind of exceptional feature. Actual receipt of income is not bothered. Clear. Now, so this part we have completed. So charging section says annual value of the property. Now understood. What type of property? It says building or any land appurtenant thereto. So land appurtenant thereto. Building means you can understand. Now let us see what is building. What is building? Let us see. Building means whether it is with roof or without roof. So whether roof is there or not, Income Tax Act is not bothered. Whether building is constructed with mud walls or cement walls, it is not bothered. It is a building only. So even though roof is not there also, it is a building only. Clear? Next, building may be either for commercial purpose or for residential purpose. So there is no distinction that building constructed you are giving for rental, for commercial, some shopping mall you are giving, or for residential purpose, some family you are giving, for stay of family you are giving. There is no, it makes no difference. Next, even large stadium or open swimming pool also considered as building. So actually the definition of building is not available in Income Tax Act. Then from where it is taken? Based on court interpretations, this is concluded. So the definition of building is nowhere it is mentioned in the income tax law, but based on court interpretations, these have been concluded. Nowadays apartment culture is there. So each flat of apartment considered as separate building. You cannot say entire apartment is one building. So each flat of apartment is considered as separate building. So what is building we understood. What is annual capacity of the house property we understood. What is building we understood. Now another word it is used, annual value of property, that is building or any land appurtenant thereto. So land appurtenant thereto means what? Let us discuss this. This also it is not defined anywhere in the income tax law. So normally if you see any house, say house will be like this, assume. So say this is compound wall. So this is entrance, say this is entrance. So if you see house is here, house is located here. What is this land? This is surrounding land, correct or not? So it is adjacent land. In connection to the house property, some land is there. This land it will be used for car parking or some playground or courtyards. So now you understood, land attached to the house till compound wall. So that is also considered as a house property only. Understood? So land appurtenant thereto. So land connected to building, it includes car parking area, or courtyards, etc. So understood what is land appurtenant thereto. Suppose outside this compound wall some land is there, it is a vacant land. Assume some vacant land is there. Okay. So this is vacant land. So vacant land, any income from this vacant land is not taxable under the head income from house property. So any income from vacant land is not taxable under this head, whereas it is taxable under income from other sources. Why it is so? Why vacant land is not taxable under this head? If you see the definition and charging section, if you see here, it is mentioned property that is building or any land appurtenant thereto, that is land attached to the building. Any vacant land, it is not covered under this charging section. So anything it is not covered in any of the heads, the residual head is income from other sources, so it will be covered there. So clear? Land appurtenant thereto, understood? Now what they use, of which SSC is the owner. If SSC is not the owner, then it cannot be considered as income from house property for the SSC. So SSC should be definitely the owner of that property. So now we are coming down to owner. So far we understood the charge in charging section. What is the annual value of house property? What are all included in house property? House property, they have included building and land appurtenant thereto. So now what is building we understood, what is land appurtenant thereto understood. Now of which SSC should be the owner. For that building or land appurtenant thereto, SSC should be the owner. Then only it is taxable for him. So now who will be considered as a owner? So how many types of owners are there? See what type of owner? Owner will be always owner, not like that. So legal owner, SSC may be legal owner. Legal owner means he has legal title. So that property is registered in his name under the Transfer of Property Act or Registration Act. So legal title is with the SSC as per Transfer of Property Act or Registration Act. So he is the legal owner. Legal owner means there is no issue at all. Definitely it is taxable for the SSC. Whatever the rental income he is earning, it is taxable under the income from house property head, and that too it is taxable for the SSC. There is no confusion, there is no doubt at all. Now comes to beneficial owner. Beneficial owner means he is not a legal owner. Legally he is not a owner. But he is enjoying the property to full extent. Then he will be considered as a beneficial owner. What is this? Legally he is not a owner, but he is enjoying the property. How it is possible? How it is possible means sometimes what will happen, registration would not have happened. Some people what they do, they will capture the land, some government lands and all, they will capture and they will start using that. So using those lands. So in that case, he is getting, see, legally it is not correct. Compelling other persons, and sometimes what they do, they will compel other persons and they start using those lands, or they will acquire the government lands and they start using. So legally that is not correct. But when it comes to payment of income tax, they have to pay the tax because they are enjoying the property to full extent, they are supposed to pay the tax. Understood? Till now any doubt is there? Any doubt till now? Yeah. You can put it in chat box, any doubt is there. Now, so another type of owner is deemed owner. Deemed owner. See, actually, for selling of land, only legal owner is entitled. Other two owners are not entitled. These other two owners, that is beneficial owner and deemed owner, only for the purpose of Income Tax Act only. They cannot sell those land. Only legal owner is entitled to sell the land because he has the legal title. Other two owners, they cannot do anything. Just for payment of Income Tax Act. Income Tax Act has prescribed them as a beneficial owner and deemed owner. Now deemed owner. So section 27 of the Income Tax Act has prescribed the deemed owner. So who are all will be considered as a deemed owner? Who will be considered as a deemed owner? So let us see now. A. Transfer to spouse or minor child. See, spouse means who? Spouse. First you should understand the meaning of spouse. For husband, wife is spouse. Other way, for wife, husband is spouse. Clear? Now, in this case, actually legal owner is there. He is the legal owner. He has transferred the property to his wife or to his minor child without adequate consideration. So consideration means, in return. Suppose you are buying one laptop. When you are buying laptop, you will pay money to the seller. So the money whatever you have paid is the consideration for the laptop sold. So similarly, when you want to sell the house, you will get some money. So money is the consideration, but that money, that consideration is not adequate, not correct consideration. If you compare fair market value, that house value is 1 crore, but you just sell for some 1 lakh rupee. Where is the 1 crore? Where is the 1 lakh? So that inadequate consideration is there. In that case, who will be the deemed owner? Even the property is now in whose name? In the wife name. Suppose Mr. X transferred. See, all these theoretical question may come in the exam point of view. Mr. X transferred to Mrs. X. He transferred to his wife. Mr. X transferred his house property to Mrs. X at rupees 1 lakh. The fair market value is 1 crore. Fair market value is 1 crore. So you can understand this case. There is a inadequate consideration. So in this case, X will be considered as transferor. Mr. X is transferor. Who is transferring the property? Mr. X. Transfer means, the meaning of transfer means sale. You will find in income tax law transfer includes sale. So you will see in capital gains chapter the meaning of transfer. So Mr. X is transferor. Mrs. X is transferee. So now legally who is the owner? Legally, because he has transferred the property, legally Mrs. X is owner. Correct or not? In spite of that, Act says Mr. X is the owner. Mr. X is deemed owner. So deeming fiction. Deeming fiction means reality Act doesn't want to see. So reality won't be bothered. Really Mrs. X is the owner, but income tax law it doesn't consider. Income tax law deeming fiction is created. So deeming fiction means in Telugu, some Telugu people are there, it will be bhavinchapadatam. Okay, so it feels that he is the owner, Mr. X is the owner. Okay, next. Yeah, so in deemed owner, deeming fiction means always deeming fiction. Reality won't be considered. For the purpose of income tax law, deeming fiction will prevail. Means income tax law assumes that he is going to be the owner. Mr. X is going to be the owner. Next case. B. And here note it. Minor child not being married daughter. Not being married daughter. So remember, minor child with married case may be there. So that is why, so in case minor child got married, minor child only, that too talks about female case only. Not minor child not being married son, like that it is not told in the act. Only for female it is mentioned. Clear? Next. Next case. Holder of impartible estate. So section, we are talking about section 27. Okay, in that first case we saw transfer to spouse or minor child without adequate consideration. Second case, holder of impartible estate. So normally take the case of, let us take one example. HUF, you would have, person definition you would have seen in the basic concept session. In that, person includes individual. HUF means Hindu undivided family. Hindu undivided family. So in HUF there will be Karta. Karta is the managing person. head of the family. In traditional Hindu families, what will happen? They will run the family business. Their head of the family. Even now, some big companies are there in India. They are still having this HUF kind of structure. So Karta managing person. So head of the family will be considered as Karta. And in this HUF, the members will be by birth. See, in case of company, if you buy the share of the company, you will be member. But in case of HUF, if you born in that family, if you take birth in that family, you will be automatically become the member. Fine. So balance members of the members will be called, balance family members will be called co-personers. Okay. So now take the case. Now one of the co-personer or family member is holding building in their own name. One of the co-personer or family member is holding building in their own name, not in the name of HUF. Even in that case, even in this case, it is deemed that building is owned by HUF only. See, what I want to say is, even though member of the family is holding, some son is holding, son of the family, even then that property as if owned by the HUF only. Income tax law deems that, assumes that, presumes that HUF is owning the property, not the family member. Clear? So why this deeming concept is required? First of all, you should understand. In the first case itself, what will happen? He has transferred. Now that spouse or minor child will get the income. They will pay the tax. What is the loss for the department? Why department is saying no, it should be deemed, it should be included in the deemed owner income? Why it is saying? So why income tax law has created deeming fiction is, sometimes what will happen, Mr. X is earning huge income, huge salary income is there. Mr. X has, why deeming fiction? I am explaining why deeming fiction. Now Mr. X is earning salary income of 25 lakhs in a year. 25 lakhs per annum he is earning. Mrs. X is not having any salary income. No income. So Mr. X, what he felt is, if he transfer building to Mrs. X, he can save income tax. Why? Even Mrs. X, he can save the income tax, whereas Mrs. X has to pay the tax. The issue is being Mrs. X has no income. As Mrs. X has no other income, she can claim basic exemption limit or not. Basic exemption limit of rupees 2.5 lakhs and can avoid payment of income tax. And due to this, X wants to transfer to Mrs. X. That is the reason IT department has introduced the concept of deemed owner. Now you understood why deeming concept is required. You understood. So people wants to find out the loopholes in the act to escape the payment of the tax, and as a counter to those acts, income tax law has brought all these concepts. Now similarly, HUF case also, member may not have any income, as his total income is lesser than the basic exemption limit. The whatever rental income he is getting, he need not pay any tax. To get the benefit out of these, so what happened? Properties and all purchased in the name of the members. So that is the reason, to checkmate this, income tax law presumes that HUF is the owner. So now what will happen? That income whatever he is getting, member he is getting, it will be included in the HUF portion. In the similarly, in the earlier case, income of Mrs. X is included in the Mr. X only. So there won't be any loss to the department. Understood why this has been brought? Now similarly, so you should remember, so who are all first transfer to spouse or minor child we have discussed. Holder of impartible estate. Impartible means indivisible estate. So impartible, partible means, partition means what? Division. So partition means division. Okay. Impartible, undivided. Understood? So holder. So who is holding? Who is holding the undivided property? Estate. HUF is holding the undivided property. So that is why that name has come out. Next. Property held by a member of a company, society, or any association. So what does it mean? What will happen sometimes, some X is there, Mr. X is there, or some Mr. Z is there, Mr. Z is there, he became the member of the association. Some association is there. Okay, the role of this association is house building scheme. What they do, what that association do, they will collect the money from all the members and they will invest in some land. Afterwards they will start constructing the houses. Okay. So after constructing, house will be allotted to, after construction of house, it will be allotted to Mr. Z. So in this whole process, Mr. Z is not the legal owner. So Mr. Z, because those houses are in the name of society only, that association only. Mr. Z is not the legal owner. Even then, Mr. Z will be considered as deemed owner, and it will be income, any income if he is getting, that will be included in the Z case only, not the society case. Okay, any doubt is there up to now? Any doubt? So far we discussed charging section 22. Under charging section we find some words. Annual value of the house property we have discussed. What is the meaning of the building? What is the land opportunity to the building we have discussed. Then what is the meaning of owner and types of owner we are discussing so far. So up till now, any doubt? Anybody can put in the chat box, any doubt is there? Yeah. Next, so last one is under section 27. This may come in the exam as a theoretical question for 4 marks. Okay, so basically 4 types of deemed owners are there, 4 to 5 types are there. So first one is transfer to spouse or minor child without consideration, or without inadequate consideration, with inadequate consideration or without consideration. Next one is holder of impartible estate. Third one is property held by member of a society. So as I already told you, these associations just they will collect the money and they will buy the land, they start constructing the houses and they will allot to the members of the association. Legally and technically those houses will be in the name of the association only. But the actual benefit who is enjoying? Members of the association only enjoying. That member only he will stay in the house, member only he will get rental income. So that is the reason, even though legally association is the owner, so Income Tax Act says member he is the beneficial owner, he has to pay the income tax. Next, a person who has acquired property under section 53 of Transfer of Property Act. See, you should understand what is Transfer of Property Act. See, we have for sale of immovable property in India, we have 2 acts. One is Transfer of Property Act, another is Registration Act. Okay, these 2 acts governs the how the property can be sold, what amount of tax to be paid to the government. Then another act is Stamp Act also there. Stamp duty we have to pay. Registration Act is there, based on which registration, any house if you buy, the buyer has to pay registration tax to the concerned state government, as well as stamp duty he has to pay. Then this Transfer of Property Act gives the rules and regulations with respect to when whether property is transferred to the buyer or not, at what point of time it got transferred. Okay, so those rules are there. Now in as Transfer of Property Act, that means 53A, what 53A of Transfer of Property Act says is, section 53A, what it is saying is, in case person has taken the possession of any building in part performance, contract, part performance of the contract, he will be. So section 53 of Transfer of Property Act, what it is saying is, if any person has taken the possession of building, possession means occupying. some if by you some Mr. A is there, Mr. A seller of building, okay, Mr. B buyer. Now Mr. B entered agreement with Mr. A that he will buy the building at 25 lakhs. 25 lakhs with the advance of, so he is paying advance also with the advance of 10 lakhs. 10 lakhs as on the date of entering the agreement. The balance money will be paid at the time of registration. So what does it mean is, so normally outside any, if you see any real estate transactions, there will be two set of transactions will be there for any purchase and sale of building. First they will enter into agreement. On agreement time they will pay some advance, and the balance money they will pay at the time of registration. They have to go to the registration office, they will pay registration tax, stamp duty, and after registration only property is legally transferred to the other side. But section 53, what it says, it is a part performance. Part performance means they have entered into agreement, okay, and that agreement is also in writing. In writing they have entered, and some advance money also paid, and the buyer has occupied. In that case, section 27 of Income Tax Act says, Mr. B is the deemed owner, because Mr. B entered agreement also with A in writing, and he has paid some money, and also Mr. B took possession of building also. Possession means occupying, occupancy. So in such situation, it is just a registration is pending. Okay, everything balance, everything it is over. Possession he has taken over. Or assume with advance of 100% you put it. Entire 25 lakhs he has paid at the time of entering agreement itself. Okay, balance, there is no chance for any balance money. And the registration is only pending. So Mr. B entered in agreement with Mr. A in writing, he entered, and he has freezed the value of the sale, that is 25 lakhs he has freezed, and entire 25 lakhs he has paid at the time of agreement itself. Only registration is pending under Registration Act. Transfer of Property Act, what it is saying is, Mr. A is the owner of the property. Since Transfer of Property Act says 53A says A is the property, Income Tax Act also says Mr. B is the deemed owner. I think little confusion is there. So as per Transfer of Property Act, Mr. B took over the position, B has entered into agreement, B has paid all the money, just registration is only pending. So Transfer of Property 53A says Mr. B is the owner. Since 53 of Transfer of Property Act says B is the owner, Income Tax Law also says under section 27 B is the owner, even though legally A is the owner. See, till registration A is the only the owner, B is not the owner. Legal owner, B is not the legal owner, because legal title is with Mr. A. Okay, so afterwards any dispute comes, it will be settled in the court of law only. So court will go through all these things and they will decide who is the actual owner. Clear? Up to now clear? Up to now clear? Any doubt is there in this case? Section 53, any doubt is there? Yeah. So we will move to the next page. So last type of deemed owner is lessee of building. Lessee of building. Under section 269 UA of income tax. In case, what this section 269 UAF says is, in case any property, any building or part thereof, any building given for lease. Lease means you can understand. Sometimes some shopping mall they want to open in your building, so you may give for lease to that some Reliance Mart and all. So in case if you are given for lease to some Reliance Mart and that lease period is more than 12 months or more than 12 years, any building is given for a lease for not less than 12 years, then the lessee will be regarded as deemed owner. Say Mr. A owns commercial house. Okay, he given lease to some Reliance Mart, assume. For 13 years, assume. Then in that case Reliance Mart is deemed owner. Okay, so not the Mr. A, being it is 13 years is more than 12 years, so Reliance Mart will be considered as deemed owner. Okay, so with this we have completed deemed owner concept. Any doubt is there up to now? Next, any doubt up to now? Okay. So now we will come back to our definition, charging section 22. So we were here, annual value of property, that is building or any land opportunity thereto, of which SSA is the owner. Now up to here we understood. Okay. And another condition is there in charging section 22 is provided SSC is not carrying or using house property for his business or profession. So one of the condition for considering income from house property under this head is SSC should not use for this house property for his business or profession. Say, so with this we have considered the deemed owner concept. So SSC should not, if SSC uses house property houses, straight away we will write building, house uses building for his business or profession, income from house property cannot be considered as considered under this head. You can ask me one question, sir, when he is using for his business, so where is the rental income? I already told you actual rental income is ignored. Annual value of the house property, it is to be paid. Income tax is to be paid on what? Annual value. So even though he is not getting any income, he is supposed to pay on annual value of the house property. But one condition is being inserted in under section 22. What is that condition? If he uses for his business or profession, then it cannot be considered as if he is deriving income from house property. So under this head, that house you should not consider. You should exclude that house. So understood. Next. So this concept is clear. Next. Now, sometimes what will happen? Let us elaborate this situation itself. Sometimes let out given to, let out means also rental, rent purpose. Let out meaning also rent purpose. Okay, so let out given to employees. See, he is not using for his business, but he has given rental to his employees. So in that case also, see, the objective of giving let out to, objective of giving let out to employees is incidental to business. The object why he has given to employees, because if he gives to employees, employees will be nearer to office, so they can contribute more to the business. So this case also, the income, suppose that he has given for some nominal rent, employer is collecting 100 per house in a month. So this income also taxable under business income only, but not under this head. Even though employer is getting some rental income, but that rental income is not subject to tax under this head. It is taxable under the business or profession only. Similarly, let out to government agencies. See, if you see some big companies, inside the premises of company, inside the company itself, post office, bank, etc. will be there. So employer has given his building on rental basis to post office or to bank. The objective again here it is only to promote his business, to improve his business. to improve the functioning of his business. So and therefore whatever the rental income he is getting, it is chargeable to tax under the income from business or profession. Under that head only it will be taxable. So let out to government agencies. So that means renting of building to post office or bank etc. by the employer is taxable under the head business or profession, but not under the head, but not under this head. Under this head means income from house property head. So clear? Again, letting out to ancillary units. See, what is the meaning of ancillary units is, if you take any big manufacturing organization, these manufacturing organizations, what they do subcontracting work. Everything will not be manufactured by the big company. Say X Limited subcontracts portion of its manufacturing activity to ABC Private Limited, a subcontractor whose factory also in the premises of X Limited only. So ABC Limited is a subcontractor. X Limited is the main company. X Limited is subcontracting its work to ABC Private Limited. ABC Private Limited, where it is located? It is located in the X Limited premises itself. For that, X Limited is collecting rent of 10,000 per month. This rent also taxable under the head. It is taxable under the head. It is taxable under the head business or profession only. Understood? Understood? Next, let us further expand this. Say if PQR Limited is there, PQR Limited is engaged in selling the properties as well as leasing the properties. So the objective of this company is the revenue structure of this company itself, selling the properties as well as leasing the properties, that is giving for rental. So in that case, the rental income earned by the PQR Limited taxable under the head income from house property only. Normally, any income earned by the company in a business is taxable under the head business or profession. That we are clear. But if income earned is in the nature of rental income, the business structure itself earning the rental income. In earlier case we saw X Limited case and letting out to government agencies. The objective is not to earn the rental income. To promote the business, it became incidental. So that is the reason there we considered under business income. But in the case of PQR Limited, being the revenue structure itself, the objective of this company itself to earn the rental income, it is taxable under the head house property only. Clear? Let us take now. So under owner we saw so many owners: deemed owner, legal owner, beneficial owner. Now if the ownership is in dispute, now who has to pay the income tax? Two persons are disputing, both are having documents, say both are having that registration documents, both went to court. Now case is pending with the court. In the meantime, that case may dispose of in the near future, but in the meantime, who has to pay the income tax? Who is collecting the rent? Who is collecting the rent? Who is collecting the rent? Or suppose he has not given on rent, he is staying in that house, self-occupied property. Then who enjoys the possession? Possession means occupying, possession of the house. See, if I have house, either I can stay. So when I am staying, that house property will be called as self-occupied property. So the owner is staying in the house, house will be termed as self-occupied house property. Owner is staying in the house, house will be termed as self-occupied house property. If house is given for lease or let out or on rental basis, then it is called let out property. So that is the reason for self-occupied house property, owner will not receive any rent, but he will enjoy the he will enjoy the possession of the house property. He will stay the house property in that house property. So that is the reason in disputed ownership they have used two parts. They have put it in two parts. Who is collecting the rent? That means let out property, or who enjoys the possession of the house? That means self-occupied property. So they will enjoy the benefits under this head, as well as they have to pay the tax under this head. Next, composite rent. Students, let us take some 5 minutes break, then we will start balance topic. Is it okay? See, just 5 minutes only. After 1 hour again I will give another 5 minutes. So don't prolong it. Okay. Thank you, students. So composite rent. Composite rent means sometimes what will happen, house with full amenities. Amenities means furniture, AC and all given for rental basis. House with full amenities is given, is let out. In such case, if rental income is separable, rental income is separable, rent towards building is taxable under the head income from house property. So if separable, if rental income is separable, similarly rent towards amenities is taxable under the head income from house other sources. If rental income, if you cannot split it to how much is towards building, how much is towards other than building, if you cannot split it, you cannot arrive it, then everything will be taxable under rental income is inseparable. Then full rent is taxable under the head income from other sources. Okay. So we understood composite rent also, how to treat it. Then co-ownership. Co-ownership, section 26. So what co-ownership says? Co-ownership means what? At a time building is owned by more than one person. See, joint ownership may be there. So joint ownership, this is a joint ownership, one or more persons jointly owning the building. How to treat this particular case? So what you have to do is share of income is to be included in the respective owner. See, his portion of income, it is to be arrived and it is to be included in the everybody's income. So suppose 1 lakh is the total income, 3 owners are there, means 33,000 it is to be included in the respective owner. So share of income is to be included in the respective owner total income. So understood? And we will see in the latter part of our session. So interest on loan can be claimed as deduction under section 24B. For self-occupied property, it is 2 lakhs. 2 lakhs deduction can be claimed. Now what I want to say is, for each co-owner can avail the benefit of rupees 2 lakhs. Understood? It is not a proportion. So this deduction you need not proportionately you need not distribute it. So every co-owner can avail the full deduction. Understood? Next. Partners property. See, these are all the specific cases how to deal, whether it is how it is taxable and all we are seeing. Composite rent, how to deal, co-ownership, how to deal. Next, partners property used by the firm. So partner has some building, in that building is used by the firm for running its business. Now whether partner has to pay tax, whether the annual value of property, whether income tax is to be payable by the partner on the annual value of the property, the answer is no. See, even though partner and partnership form are both are different, but being it is used for the business, when it is used for the business, section 22 what it is says, it is to be excluded from the purview of this head, and therefore it need not be included in the income. Clear? Any doubt is there? Next, this is important. Property held as stock in trade. So property held as stock in trade means one company is there, XYZ, it is XYZ company is there. Business objective is to sell the house properties. So its business itself, real estate business, buying and selling. So now, as at the end of the year, some property will be there in the stock, means unsold property. So unsold property as at the end of the year, how to deal with that? How to deal? Means whether income tax, whether annual value of the house properties on which income tax is to be payable or not under the income tax, under this income from house property head. So that is the question. So the answer is up to 2 years from the end of financial year in which certificate of completion of construction is obtained. Annual value of property is taken as nil. That means what? Once house property construction is completed, and for that completion, if you have obtained any certificate, after obtaining the certificate, till next 2 years, its annual value of property is to be considered as nil. See, as I already told you, if any person is dealing in the business of selling the house properties and leasing the house properties, whatever the rental income obtained will be taxable under the income from house property head only, not under the business or profession head. So therefore, some house property, unsold house properties are there. So for those cases, even though actual income he is not getting, any rental income he is not getting, its annual value of property on which tax is to be payable in generally. But on section 23(5) says up to 2 years from the date of obtaining of completion report. from the end of the financial year. Suppose completion report means what will happen, any house is constructed, any apartment if you take, after its completion, the constructor or builder has to go to the concerned authority and they have to obtain the completion certificate. Afterwards only that these tenants or the buyers can occupy in that apartment. Okay, now completion report is obtained on somewhere in 1st January 2022. Now from the end of its financial year, that is financial year is ending what time? 31st March 2022. From here you have to leave the 2 years. So 2 years it is excluded. So 2 years to be excluded. So that means from 1st April 2024 onwards, income tax is payable. Okay, so in these 2 years, its annual income will be, annual value is considered as nil. Understood? Any doubt is there? Understood? Any doubt? Yeah. Let us move into the next concept. Exempted properties. So exempted properties means income from these house properties are exempted. Income tax need not be payable. So normally if you find in income tax law, section 10 gives all exemptions. Section 10 gives all exemptions. If you take gratuity, income exemption, leave salary encashment exemption, pension exemption, all will be in section 10 only. So similarly, house property of a local authority. In village, local panchayat is a local authority in village. So house property of a local authority. So exempted properties, all these are all. So similarly, house is used for scientific research. House is used for scientific research, and it should be approved. That research project should be approved research project. Okay, so approved project. So then only that exemption can be availed. Next, house property of educational institution. Educational institution, suppose it is occupying some 3-4 buildings. So all are exempted. Next, similarly for house property of educational institution or hospital or political party or farmhouse. Farmhouse means it is that house is located in the vicinity of agricultural land or for charitable purpose. So all these are all exempted. You may find bit mark questions here. Okay, so with this we have completed all basic concepts under this head. Now let us move into how to determine the taxable income under this head. So determination, how to determine. So section 23 comes here. Section 23 talks about let out property. For let out property, how to determine the taxable income. Section 23 talks about let out property. So normally the format for determination of taxable income is you have to arrive gross annual value. I will explain each one of it is I will explain later. So you have to arrive the gross annual value, from which you have to reduce municipal taxes. After reducing municipal taxes, you will get net annual value. So this is the structure of determination of taxable income. Then you will have deductions. Deductions under section 24A. Under section 24B, you have two deductions. So these deductions are exhaustive. Exhaustive means no more deduction you will get other than these two. 24B. So under section 24A talks about standard deduction, which is 30% of NAV, net annual value. 30% of net annual value. And 24B talks about interest on borrowed capital. So after giving the deductions, you will get income from house property. So this is the structure of determination of taxable income. Now what is gross annual value? As we already discussed, section 22 talks about annual value of the house property. So actual rental income, it is just ignoring. Yes. So how to arrive the gross annual value? Let us see. That is GAV. How to arrive this? Tax says you should take the municipal valuation. You should take the municipal valuation. So if you see municipal record, municipal office if you go, or any local authority, okay, or HMDA, like that, so many city to city it is varying the names. So as per those authorities, for payment of municipal tax, what is the value? See, municipal tax in some cities it is to be paid annually, some cities, some villages it may be paid half yearly, like that it is there. For the whole year, for the 1 year, what is the value? Normally municipal value will be there as a percentage of the annual value, say 10%. So, as per municipal records, what is the value is there, annual value. So, that is to be considered. Next. So, fair rent. So, municipal value is as per records of municipality or any other authority. Next comes to fair rent. Fair rent means for similar house, for similar house in that locality, how much rent received for similar house in that locality. So like our house in the similar locality, similar house is there, how much rent it is fetching, that you have to consider. So you should take higher of the above. Now you got the municipal value as per municipal records, and fair value is the similar house how much rent it is fetching. So you have two values. So you should take higher of the above. Higher of the above. And you should restrict or limit to the standard rent. What is standard rent? We have Rent Control Act in most of the states. So as per Rent Control Act, so it is a regulation kind of act. So to avoid exploitation from the tenants, maximum ceilings have been kept. So beyond that owner of the house should not get the rent, should not collect the rent. So as per Rent Control Act, so maximum rents are prescribed. So legally owner is not supposed to collect beyond these limits. So that is the reason above value is restricted to standard rent. So say municipal rent is A, fair rent is B, standard rent is C. So what is our formula for GAV is higher of A comma B restricted to C. Now say municipal value is 10,000. Okay. So normally municipal taxes will be percentage, some 10%. So 10,000 into 10%. So 1,000 is to be payable as municipal tax. So to collect the municipal taxes, municipalities are maintaining the municipal valuation. Okay. So fair value is suppose say 12,000. Standard rent as per Rent Control Act is 8,000. Now in this scenario, how much will be gross annual value? Higher of 10,000 or 12,000? That is 12,000. So fair value is higher, which is restricted to standard rent, restricted to 8,000. Therefore GAV is equal to 8,000. Gross annual value is 8,000. Understood? So this is how actual earning capacity of the house is arrived. In any of the steps have you find actual rent received? So actual rent received is ignored. Correct or not? So we are going by the earning capacity of the house. Okay. However, sometimes what will happen? Actual rent received may be higher than this value. So that means what? Suppose somebody is collecting rent of 15,000. As per our calculation, earning capacity has come 8,000 only. But 15,000 rent collected. That means what? The actual earning capacity is 15,000. So department wants to consider actual earning capacity than theoretical earning capacity. This is theoretical earning capacity. So this is called as, so whatever we have calculated, it is not going to be gross annual value. So this will be considered as reasonable expected rent, RER. So expected rent. So first whatever we have calculated so far is reasonable expected rent. So reasonable expected rent, what you have to do? Municipal value you have to take, fair value you have to take. Whichever is higher you have to consider, and we have to restrict to standard rent. That is called reasonable expected rent. Then you have to arrive the actual rent receivable. So maybe this theoretical earning capacity may be sometimes may be lower. So we have to see the actual rent receivable. Okay. So actual rent receivable. ARR also you have to arrive. ARR also you have to arrive. So actual rent receivable, how you will arrive? For 12 months, for example, for 12 months, rent per month is 1000. For 12 months, it is 12 into 1000. It is going to be 12,000. So, in our earlier example, reasonable expected rent, how much you got? 8,000. So, ARR, how much you got? Actual rent receivable is 12,000. So, again you have to take higher of RER or ARR is going to be your gross annual value. So, section 22 says only annual value of the house property you have to see. But again you are seeing here actual rent receivable. Suppose actual rent received is 0. You have given it free of cost to your relative. So obviously you are seeing RER will be your gross annual value. So actual rent receipt you are ignoring. You are just going by theoretical rent capacity. Students, any doubt up to here? Any doubt? Any doubt, you can put it in the chat box. Yeah. See, all these why it is coming? Because department believes that some people they may manipulate. They may say paid rent, they may reduce it. Or sometimes what will happen, municipal records, some of the states what will happen, they may not update the actual value, municipal valuation, they may not do it frequently. So to cap all those things, so department has brought into this actual rent receivable concept also. See, somebody is getting more than theoretical rent, somebody is getting more means what? That is going to be the actual earning capacity of the house. And also to checkmate the case of giving the houses at lower rents, this theoretical earning capacity concept has been brought. Sometimes what they do, they will take 50% of rent only through through bank account, balance 50% they may take through cash account. So to checkmate all those cases, this municipal rent or pay rent, whichever is higher, subject to maximum standard rent, this concept has been brought. That is the reason section 22 says annual value of the house property is to be considered. Now further let us elaborate. So up to RER we don't have any doubt. RER is simply municipal value or fair rent, whichever is higher, subject to standard rent. That is very clear. Now actual rent receivable only we have to elaborate further. So actual rent receivable. Further we will elaborate. So finally, gross annual value is higher of rent, actual theoretical rent receivable, rent receipt, or actual rent receipt. Whichever is higher, we have to consider. But further, we will elaborate actual rent receipt. Some cases we will find. Sometimes unrealized rent will be there. How to deal? Unrealized rent means tenant is not paying the rent. See, here if you see, the word I have used is receivable, not received. So receivable means whether tenant has paid or not, that I have considered. And also sometimes what will happen, that house is vacant, 1 or 2 months vacant, it is lying vacant, no tenant has occupied. So how to deal those cases we will see now. So unrealized rent, how to deal, as well as vacancy, how to deal. So these two cases we have to see. While arriving the actual rent receivable, how to deal with unrealized rent and vacancy we have to see. So what income tax law says is, unrealized rent can be deducted while arriving the ARR, actual rent receivable. So suppose in our earlier example, now I am talking about unrealized rent. Okay. So in our earlier example, finally we arrive at gross annual value is equal to this one. So in our earlier example, ARR is 12,000 for 12 months. Out of 12,000, for 2 months the rent is not paid. 2 months rent unpaid. So for comparison purpose, you have to ARR minus unrealized rent, you have to put it. Unrealized rent how much? So 12,000 minus 2,000. 2,000 is 2 into 1,000. 1,000 per month rent. So 2,000 we could not realize from the tenant. So now gross annual value is going to become GAV is equal to higher of RER. RER, reasonable expected rent, that is municipal value or fair value, whichever is higher, subject to standard rent. Higher of RER or ARR minus unrealized rent. So in case unrealized rent is there, you should reduce from the ARR. So now how much it will become? Higher of 8,000 or 12,000 minus 2,000, that is 10,000. Is becoming 10,000. However, some conditions have been prescribed for allowing unrealized rent as a deduction. Some conditions have been prescribed. So what will happen? So many people will start saying, sir, I have not realized the rent. So that is the reason some conditions have been notified. What are all those conditions? The tenancy should be bona fide tenancy. That means really that tenancy is existing, not fake records, not fake tenancy. And also, when somebody is not, tenant is not paying rent, owner should take steps to vacate that tenant from house. See, tenant is not paying rent means he should not keep him in the house. He should take steps to vacate him out. Next, tenant is not paying rent not only in this house, any of the houses owned by the owner also, tenant should not stay. So tenant should not stay in any of the houses owned by the owner, and legal proceedings also would have initiated. Legally also action is taken on the against the tenant. So if all these conditions are satisfied, then only unrealized rent should be deducted from the actual rent receivable. Clear? Let us see some problems, then you can understand. Yeah. Students, are you able to see this problem? Able to see this problem? So they are not asking the gross annual value. So gross annual value, for arriving the gross annual value, first we have to arrive the reasonable expected rent, second we have to arrive the actual rent receivable. Two parts are there. Whichever is higher we have to take. Now so what they are asking is only RER they are asking, reasonable expected rent. Reasonable expected rent is how you will arrive? Maximum of municipal rent or fair rent subject to standard rent. So now if you see, if you see the above example, municipal rent or fair rent, whichever is higher. So 10,000 or 8,000, 10,000 is higher. Standard rent also 10,000. So reasonable expected rent is 10,000. Second case, if you see, whichever is municipal rent or fair rent, whichever is higher, 12,000 or 16,000. So 16,000 is higher, subject to standard rent. So being standard rent is less, so 14,000. In case standard rent suppose not available, we will just ignore the standard rent. We will go ahead with the municipal rent and fair rent. Third case, if you see, in third case, standard rent is not available. Then we will ignore that. Just we go by municipal value, municipal rent or fair rent, whichever is higher. Fourth case, if you see, municipal rent is higher, 18,000 or 10,000. Municipal rent is 18,000, which is higher. Standard rent is only 8,000. So your reasonable expected rent is restricted to 8,000. So this is basically theoretical rent. Clear? Next. Now in the question, if you see, they are asking us to calculate the gross annual value. So gross annual value, how we will arrive? For arriving the gross annual value GAV is equal to, we have to arrive first RER we have to arrive. So first step is reasonable expected rent we have to arrive. So RER, how we will arrive? Higher of municipal rent or fair rent subject to standard rent. So this is RER. Then second step is actual rent receivable we have to arrive. Actual rent receivable. Okay. From here reduce unrealized rent. Then third step is GAV is equal higher of RER or ARR minus unrealized rent. So this is how we have to arrive. Now if you see here, so house 1, let us come to house 1. So gross municipal value 120, fair rent is 105. So whichever is higher, 120 is higher. Okay, standard rent is being not available, so our RER is equal to 120. Let us put here. So reasonable expected rent, RER is equal to 120. Okay, actual rent receivable 100. So it is receivable. Receivable means for the whole year. Okay, so how much? ARR is equal to actual rent receivable is equal to 100. Okay, so whichever is higher is GAV. So GAV is equal to whichever is higher, 120. Clear? Next. So similarly for second case, so whichever is higher, 130 or 115, 130, subject to standard rent, that is 100. So RER is equal to 100. RER is equal to 100. Actual rent receivable how much? 110. Whichever is higher, RER or ARR, whichever is higher. So gross annual value will become 110. Next case, municipal value or paid rent, whichever is higher. So that is 140, subject to standard rent. 140 or 135, whichever is lower again. So 135. Actual rent receivable also 135. So whichever is higher is also 135. Next, H4 case, municipal rent or fair rent, whichever is higher. So fair rent is higher, so that is 155, subject to standard rent. So maximum standard rent, we have to restrict to standard rent. So 155 being standard rent is higher, so 155 is allowed. So you don't take higher of all these three, that is incorrect. You should take, first you should arrive higher of municipal rent or fair rent, that is 155. Now this 155 is, if it is less than standard rent, it is fine, you can take 155. Here, suppose standard rent is less than 155, suppose instead of 180 it is 100, then you should restrict to 100. If standard rent is higher side, no problem, you can directly take higher of municipal rent or fair rent. So in this case, it is becoming 155. So let me explain in local language. So mere any Telugu person is there. So municipal value or fair rent, ఈ రెండిట్లో ఏది ఎక్కువ ఉందో ఫస్ట్ అది అరైవ్ అయ్యి స్టాండర్డ్ రెంట్కి రెస్ట్రిక్ట్ చేసుకోవాలి. సపోజ్ స్టాండర్డ్ రెంట్ కనుక తక్కువ ఉంటే మనం ఆ తక్కువదే తీసుకోవాలి. ఇప్పుడు ఈ 180 ప్లేస్లో 100 ఉందనుకోండి, హైయర్ ఎంత అవుతుంది 155, కానీ స్టాండర్డ్ రెంట్ తక్కువ ఉండటం మూలంగా 100 మన రీజనబుల్ ఎక్స్పెక్టెడ్ రెంట్ అవుతుంది. Similarly, in Tamil also, ఏది పెరిగే అమౌంట్ అది ఎడుకున్నాం. సపోజ్ ఇప్పుడు మున్సిపల్ రెంట్, ఫెయిర్ రెంట్, సపోజ్ ఇన్ ద హెచ్వై కేసులో பெரிய அமௌண்ட் எது 175. ஸோ 175 வந்து நம்ம ரெஸ்ட்ரிக்ட் பண்ணணும். ஸோ 175 எதுக்கு ரெஸ்ட்ரிக்ட் பண்ணணும்? ஸ்டாண்டர்ட் ரெண்ட்டுக்கு ரெஸ்ட்ரிக்ட் பண்ணணும். ஸோ ஸ்டாண்டர்ட் ரெண்ட் 165 தான். அதனால தான் நம்ம ஸ்டாண்டர்ட் இப்போ ஆர்இஆர் என்ன ஆகும் 165 ஆகும். suppose standard rent 200 இருக்குது. So whichever is higher எவ்வளவு ஆகும் 175. So 175 வந்து 200 கம்மி தான் இருக்குது. So அதனால டைரக்ட்லி நம்ம 175 எடுக்கலாம். So ஸ்டாண்டர்ட் ரெண்ட் கிராஸ் ஆகி போறாது, அது மட்டும் பார்க்கணும். Clear? So now we have arrived the reasonable expected rent. So ARR vandu already it is given, actual rent receivable it is given. You have to compare whichever is higher is gross annual value. Any doubt is there, students? Any doubt? Till now any doubt? Let us see another example. So in this example, unrealized rent also there, you will better understand. So I am coming to house 1. So whichever is municipal rent or fair rent, whichever is higher. So whichever is higher is 300. Being standard rent is only 50. So 50. So I have to take whichever is lower. So RER is equal to 50. Clear? Now I am coming to ARR. ARR is per annum they have given. How much? 120. Correct? Now ARR minus unrealized rent. So for arriving the GAV, I should compare RER minus RER and ARR minus UR. So higher of these two, higher of what? RER comma ARR minus unrealized rent. Okay, so now I have to arrive ARR minus unrealized rent. ARR straight away given in the problem. So unrealized rent for how many months? 2 months. So for 2 months, for 1 year it is 120. So for 2 months 120 in thousands. So I am calling thousands, I am ignoring, I am calling it as 120 for example. So 120 into 2 months, 120 into 2 divided by 12. If you put unrealized rent you will get. So unrealized rent is equal to unrealized rent is equal to 120 for 2 months. This is for 1 year. So 2 divided by 12. So how much rent I have not collected? Realized, unrealized means I have not collected. How much? So 120 into 2 divided by 12. So this is going to be 20 rupees. So now ARR minus. So actually I am supposed to receive this much, but how much I have received? 120 minus 20. So this is becoming 100. Now my GAV should be RER, that is higher of 50 comma ARR minus unrealized, that is 100. So it is going to be how much? Higher of 50 comma 100, that is going to be 100. So GAV is equal to 100. So what department wants to grab is, in this case theoretical rent is only 50 rupees, but actually when SSC is getting more rent, so that is going to be the earning capacity of the house. However, unrealized rent, department doesn't want to tax for the portion of rent which is not received by the SSC. SSC has not collected, so the department doesn't want to penalize the SSC. So that is the reason unrealized rent is given as a deduction. Let us see another house. So municipal rent or fair rent, whichever is higher. That means what? 500. It is restricted to standard rent. So 500 being less than standard rent, 500 is going to be my RER. Don't take whichever is higher. don't consider 800. So standard rent is only ceiling. Standard rent is not going to be your RER. Standard rent is only for restriction. So higher of all these three things don't consider. So RER is 500. Next, ARR how much? It is straight away given in the problem, 600. ARR minus unrealized rent how much? So for that I have to arrive the unrealized rent. Unrealized rent is, for 1 year it is 600. How many months I have not collected? 3 divided by 12. So 600 into 3 divided by 12. So 150 I have not collected. I have not realized. So ARR minus unrealized rent is equal to 600 minus 150. So this is going to be 450. So my gross annual value is equal to higher of RER comma ARR minus unrealized rent. So 600 or 450. So sorry, 500 or 450. 500 is my RER. ARR minus unrealized rent is 450. So higher amount is 500. So in this way we have to arrive the unrealized rent. Okay, let us move to the next question. So in this question we will deal with vacancy. Now you understood, so far you understood gross annual value is equal higher of RER and ARR minus unrealized rent. Whichever is higher you have to consider it as a gross annual value. RER is equal to municipal rent or fair rent. Whichever is higher you have to take, you have to restrict to standard rent. This up to now you have understood. But income tax department wants to give deduction towards vacancy also. See, house is vacant, no tenant has come and occupied. So in that period definitely SSC would have not received any income. So department wants to give deduction towards vacancy also, provided it is not giving straight away deduction like unrealized rent straight away you are reducing and then you are comparing, but vacancy is not so. So let us see one case, you will understand how to arrive GAV when vacancy is there. So in this case if you take whichever is higher, that is 300 is higher, municipal rent or fair rent, gross municipal value or fair rent, whichever is higher you have taken. Restricted to standard rent, being standard rent also 300, so your RER is equal to 300. Okay, fine. Now your actual rent it is given for per annum, it is 600. Okay. Now which one is higher? GAV is equal to whichever is higher, that is automatically 600. But you have to understand here vacancy is there. So vacancy is for how many months? For 1 month it is there. So your actual rent ARR is going to be for 1 month, if you reduce it 600 into 1 divided by 12. So 600 minus 50, it is going to be 550. So your GAV is 550. So that means what? Vacancy also you have to reduce from the ARR until it is more than RER. You can straight away reduce it. Now let us see next case. You will get more clarity. You just wait until the completion of this problem, you will get more clarity. Yeah. So whichever is higher, 600. So RER is equal to I am at house 2. So whichever is higher, RER and restricted to standard rent. So my RER is going to be 180. So up to here you understood. Whichever is higher and you have to restrict to standard rent. That is clear. Now my ARR minus vacancy, how much it is coming? ARR is 900. Okay, for 3 months how much rent? 900 into 3 divided by 12, so 225. So 900 minus 225. 225 how I have arrived? 900 into 3 months it is vacant. So vacancy period is rent is 225. So net I how much I have received? So 900 minus 225. So it is 675. So in this case also, till it is higher, no problem. So straight away we will pay for our gross annual value is going to be 675 only. So next house. Next house. So here you will understand what is the impact of vacancy. So whichever is higher, 750 and restricted to 280. So my RER is equal to reasonable expected rent is equal to 280. And my actual rent received minus vacancy is equal to how much it is becoming? 300. Vacancy for 2 months. So 300 into, so this is for whole year rent. So out of which vacancy is there. So vacancy period is 2 divided by 12. So it is becoming 250. In the earlier two cases, that is for house 1 and house 2, ARR minus vacancy is higher than the reasonable rent. So that is why we have closed our eyes and straight away GAV we have considered as this one. But now in this case, whichever is higher, this is coming as only 250. RER is 280. So my RER is coming. So SSC has to pay tax on RER. So that is 280 normally. Now in this scenario you have to see one thing. So GAV is equal normally whichever is higher, but so it is becoming 280. Normally it is becoming 280. So ARR minus vacancy is equal 250. So higher of 280 or 250. So whichever is 280. Normally we will pay for this, but the reduction in ARR is due to vacancy. If vacancy is not there, assume vacancy, if it is not there, how much would be the rent receivable? 300. Correct or not? Vacancy is not there. So that ARR is more than RER. So 300 is more than 280. So reduction in ARR minus vacancy, if it is due to vacancy, then you should consider ARR minus vacancies as GAV. Yeah, once again I will explain. So impact of vacancy. Normally for arriving gross annual value, higher of reasonable expected rent or higher of reasonable expected rent and actual rent receivable reduced by unrealized rent and vacancy rent attributable towards vacancy period. That means normally for arriving GAV we were considering higher of RER and ARR minus unrealized rent minus rent for vacancy period. So this is the formula. In this case, if ARR minus unrealized rent minus rent for vacancy period so if ARR minus unrealized rent minus rent for vacancy period is more than RER, then GAV is equal this one. So what I want to say is, while comparing RER with ARR, you should give deduction for unrealized rent as well as rent for vacancy period also you should reduce, and then you have to compare. But if we after comparing if actual rent receivable is more than this theoretical rent, that is RER, then no problem. So normal rule only, whichever is higher only we will follow. But in case RER is more than RER is coming more, then ARR is lower due to ARR minus RER is more than ARR minus UR minus rent for vacancy period, then lower due to vacancy, then principle of normal principle will not prevail. That is ARR minus UR minus rent for vacancy period is to be considered. Now let me elaborate here with one example. Assume RER has come 100 rupees. ARR minus UR unrealized rent minus rent for vacancy period has come 120 rupees. So after reducing the from annual rent receivable, unrealized rent you have reduced, and rent towards vacancy period also you have reduced, it has come 120, which is more than RER, then your gross annual value is equal to 100 only. Sorry, whichever is higher. So 120 only. Suppose other case, so if ARR minus UR minus rent per vacancy period comes higher, then normal principle apply, whichever is higher. But other case, reverse case, RER is equal to 100 and ARR minus this comes 80, then you should think of it, whether the reduction is due to vacancy, then higher concept won't prevail. Then you have to consider reduction is due to, then GAV is equal to 80 only. Higher concept won't work. Understood, students? Any doubt is there up to now? Up to now, any doubt is there? Up to now, any doubt is there? Madam, now you understood something. You have put it 900 by 12 into 3. Now it got clarified, or still it is open? Doubt is open, or it got clarified? So what I want to say is, normally GAV will be higher of RER or ARR minus UR minus vacancy period rent. But if RER is more than this ARR minus UR minus vacancy period rent, then only you have to understand whether that reduction is due to vacancy or not. If it is due to vacancy, the principle of higher will not work. Straight away you can take ARR minus UR minus rent attributable to vacancy period. Okay, clear? Let us take one problem, you will understand. Yeah, this problem, let us see, you will understand. So please follow with me, everybody. Now for house 1, I am at house 1. Municipal value or fair rent, whichever is higher. Whichever is higher means 150. So here it is 150. Restricted to standard rent. So my RER will be 120. And this case, for house 3 case, whichever is higher, 180, restricted to standard rent. So being standard rent is higher side, you can straight away go ahead with 180. Now whichever is higher, 240, standard rent is more only. Suppose standard rent is less, you have to take standard rent. If standard rent is more, then you can ignore standard rent. So straight away you can take 240. Now I have arrived my RER. Now problem is with the ARR only. So ARR, actual rent property, is let out throughout the previous year. That means what? It is for the whole year it is given. That too before reducing unrealized rent and vacancy period it is given. Because if it is let out throughout the year, so before reducing unrealized rent and vacancy period it has been given. So just they have given whatever it is, ARR only. ARR is equal to 180, 300, 150. So I am supposed to arrive unrealized rent. So students, please note that unrealized rent you have to consider for the current previous year only. Okay, so how much is the current unrealized rent? 25, 40, 20. So how much you are getting? 180 minus 25, 155. 300 minus 40, 260, 130. Next, vacancy period also there. Vacancy period is for 3 months. So for 3 months vacancy period, rent attributable to vacancy period, rent attributable, belonging attributable to vacancy period. So how much? For first case, 180 into 3 by 12. It will become 180 into 3 by 12. So 45. So vacancy period rent is 45. Similarly here, 300 for whole year rent is 300 into 1 divided by 12. For 1 month it is vacant. That means 300 divided by 12, 25. Here no vacancy is there. No vacancy. Now what I want to arrive is ARR minus UR minus rent belonging to vacancy period, rent for vacancy period. So if I reduce, already ARR minus UR I have, so from this I will reduce 45. So 155 minus 45 is becoming 110. Similarly 260 minus 25, 260 minus 25, how much it is becoming? 235. So here it will become 130. Now basically I have to compare now. So to arrive the gross annual value, I have to compare this and this. So whichever is higher we have to see. So 120 and 110, 180, 235. So whichever is higher, if this one comes as whichever is higher, straight away you can take. So second case 180 and 235 you can take it. So balance cases only you have to think of. So balance case, if vacancy is there, then only you have to think. Third case, there is no vacancy. When there is no vacancy, higher concept will prevail. Vacancy is there, then only you should think. When there is no vacancy, higher concept will prevail. 240 or 130, whichever is higher. So straight away 240 will come. So two cases we have completed. Now coming to here, in this case, reasonable expected rent is 120. Whereas ARR minus UR minus rent for vacancy is 110. General rule is what? Higher concept, higher rule will prevail. Normally it will be 120. But in this case, being vacancy is there, you have to think the reduction is due to vacancy or not. Suppose if vacancy is not there, what would be the ARR minus UR? This without vacancy, what would be my rent? 155 rupees, which is more than 120. So why it has fallen down to 110? Due to vacancy. If vacancy is not there, my ARR minus UR will be 155. Therefore, the reduction is due to vacancy. Therefore, my GAV is 110. It is not 120. Higher concept will not work. So what I have done it here is, once again for house one case I am explaining, I have to compare reasonable rent and this one, ARR minus UR minus rent for this thing. If it is, this is higher, B is higher, straight away I will take, but B is lower. The lower is due to vacancy or not, we have to see. If vacancy is not there, my B value will be 155, which is more than RER. So the reduction is due to vacancy only. Therefore, I have to take ARR minus UR minus rent for vacancy. Higher concept won't work. Students, I presume it is clear. Any doubt is there, you can ask. And also in the problem, they have confused you. They have given unrealized rent for previous years also. It is no way connected. In the problem, if you see, they have given unrealized rent of the prior to previous year. This we are not bothered. Only for current year unrealized rent only we have to consider. Students, up to now is it clear? Let us move to next concept. Yeah. Now we have arrived at the GAB. So if our determination of taxable income, if we see for let out property, we have arrived at the gross annual value. Now out of which we have to reduce municipal taxes. So municipal taxes, how much we have to reduce? On what basis we have to reduce, we have to see. So municipal taxes, so from gross annual value you have to reduce municipal taxes, whether it is cash basis or accrual basis. Municipal taxes you have not yet paid. Whether unpaid municipal taxes also, can you claim deduction? The answer is no. Only actual value of municipal taxes paid can be deducted from gross annual value. Okay. So that means what? If you pay previous year municipal taxes now, that you can claim deduction. Even taxes relating to previous year, preceding years can be claimed as deduction. Clear up to now? Suppose if municipal taxes are more than the GAV, taxes are more than my rental value, then what is going to be my NAV, net annual value? My net annual value will be negative. Okay. If I pay advance municipal tax, what is going to happen? For future years I will pay now itself. Suppose I feel my this year rental income is more, so better I will pay future years municipal taxes also now, and I will claim more deduction, so that I will pay lesser income tax. So if you think this way, advance municipal taxes is not allowed, because these are all taxes can be claimed on cash basis. So when there is no levy from the municipal authorities, you cannot claim it as a deduction. So advance municipal taxes paid is not allowed as a deduction. Next. So here municipal tax now includes not only includes even sewerage tax. Sewerage means wastage. Sewerage tax, water tax. So all these are all municipal taxes only. You can claim at claim as a deduction. Clear? On cash basis you can claim. So now we have arrived at net annual value. After reducing the municipal taxes, you will arrive the net annual value. After arriving the net annual value, you will have deductions. So we have already understood only two types of deductions are available. So section 24B says 30% standard deduction. For salary, standard deduction is 50,000. So for house property, the standard deduction is 30% of NAV. Okay, so 30% of standard deduction, 30% standard deduction is available. Okay, it is to be calculated 30% on NAV. Okay, now suppose if your NAV is negative or 0, standard deduction cannot be claimed. See, when your income is not there, you cannot claim the deduction. So department won't, refund the money. Clear? Next. Next concept is, within deductions we have seen standard deduction, that is 30% of NAV. Another deduction is interest on loan, housing loan. See, for construction or purchase of house, whatever the loan taken on which interest, if anything, is paid, can be claimed as a deduction. Okay, so interest on housing loan, whether any limit is there, any limit on deduction. For let out property, no limit, anything you can claim, whatever the interest paid, can be claimed as a deduction. For self-occupied property, we have a limit. So what is the limit? So for self-occupied property, if house purchased or constructed prior to 1st April 1999, then 30,000 only allowed as deduction. Whether you pay interest of 2 lakhs, 3 lakhs, whatever it is there, only 30,000 only you can claim as a deduction. For let out property, there is no limit. The limits are only applicable for self-occupied property. Okay, for self-occupied property, if house purchased or constructed prior to 1/4/1999, 30,000 maximum deduction for interest paid on loan taken. Okay, next, if house purchased or constructed after on or after 1/4/1999, then the limit is 2 lakhs. Maximum limit is maximum 2 lakhs you can claim as a deduction. If you pay interest of 3 lakh rupee in a year, 2 lakhs you can claim as a deduction. For repairs, whether you bought prior to 1/4/1999 or post 1/4/1999, any case, for repairs, any case, it is only 30,000 rupees. So understood? So this is the maximum limit. For let out property, whatever, how much you have paid, 5 lakhs, 10 lakhs, you can claim as a deduction. Whereas for self-occupied property, you have to see whether it is for repair or for loan borrowed is for repair purpose or for purchase or construction. So you have to see self-occupied case, you have to see self-occupied case, you have to see repair or purchase. Or construction. If it is for repair, 30,000 only. If it is for purchase or construction, again you have to see the date of purchase. Date of purchase. If it is date of purchase is prior to 1st April 1999, then 30,000 only. On or after, it is 2 lakhs. I think clear? Yes. So next concept, interest on pre-construction period. Interest on pre-construction period. See, it is applicable only for construction cases. See, if you want, this concept is applicable only for construction cases. Whatever I am going to tell. Suppose you borrowed the loan taken on 1st April 2022. Construction started. Construction commenced on 30th June 2022. Okay. Construction completed on, assume construction completed on 30th June 2023. Okay. Now, or let us have this case, 2020 loan taken, construction completed on, commenced on 30th June 2020, construction completed on 22. So how many years, financial years are there in this case? From 1/4/2020 to 21. 2021, 21-22. 2 financial years are there. So when house is not constructed, you don't have any income. Rental income won't be there. So from where you will set off this interest deduction? So that is the reason what the Act is saying, pre-construction period interest. So What before construction, after construction only rental income starts. So prior to construction you don't have any income, so the deduction for that portion, that period, you can claim in 5 equal installments once the construction is completed. Understood? So let us, what law is saying is, interest pertaining to pre-construction period can be claimed in 5 equal installments. Five equal installments. Clear? From the year of completion of construction. Note, interest deduction, interest will be allowed for deduction from the date of commencement of construction. But not from the date of obtaining the loan. That means what I want to say is, see, in this case if you see, he has taken loan on 1st April 2020, but construction when it started 30th June only, so 3 months gap is there. For these 3 months whatever the interest is there, that won't be allowed as a deduction. First point, it is clear. Now assume I have taken loan of 10 lakhs. That loan of 10 lakhs I have taken at the rate of 10% per annum. Now for financial year or for income tax, being it is income tax, better to is previous year, yeah, whatever it is, financial year 2021. Don't take interest calculation from the date of loan. You have to take from construction commencement. Being it is commenced on so and so. So first 3 months better to exclude it. Okay. So assume, suppose it is commenced on 1st July means. So first 3 months you can straight away exclude it. So 10 lakhs into 10 divided by 100 into 9 divided by 12. So how much is going to be interest? 75,000. Okay, for next financial year 2021-22, assume you have not paid any loan, repayment has not been made. So 10 divided by 100 is becoming 1 lakh. Now yeah, we will move to next page. So total pre-construction period interest is you see how, when it got completed, construction got completed in the financial year 22-23. So pre-construction period interest is, that is up to 31st March 2022 only. So you should calculate interest, pre-construction period interest is up to, so pre-construction period interest is up to is from 1st July 2020, where really construction commencement, construction is got commenced from that period to 31st March 2022. Till that time only it will be considered as a pre-construction period, because actually it ended in the year 22-23. So pre-construction period is year in which it got ended. So prior to that 31st March, till 31st March you have to take. So because it got ended, construction got completed in the year, in the month June 22, pre-construction period is up to previous year 31st March. So from 1st July 2020 to 31st March 2022 only will be considered as pre-construction period. So why these 3 months it is not considered? From 31st March 2022 to 30th June 2022, why it is not considered as a pre-construction period is, anyhow asset, a house came into, house got completed construction, he will realize some revenue. So these 3 months interest he can anyhow claim in the same year as a deduction. Problem is with the previous years only, because house construction, it was not completed, he will not realize any revenue, so deduction he cannot obtain. So that is the reason the year in which it was completed, for the partial portion will not be kept under pre-construction period. Understood? Yeah. So pre-construction, total pre-construction period interest is, that is from 1st July 2020 to 31st March 2020, the interest is coming to, total pre-construction period interest is 1,75,000. So this is to be claimed in 5 equal installments. It comes to 1,75,000 divided by 5, 35,000 per annum can be claimed as deduction from the previous year, commencing from 2020 to 2023. So it got ended in this year. So in this year onwards, including this year, in 5 equal installments you can claim as a deduction. So 35,000 can be claimed as a deduction under section 24B. So section 24B includes 2 types of interest: pre-construction period interest for first 5 years, as well as post-construction period interest, it will be included. So students, with this I am concluding. The next session we will complete the balance chapter. Thank you.